Feeling that familiar pressure as retirement starts to loom on the horizon? Maybe you're looking at your savings and thinking, can I really do this? Don't panic, because you've landed in exactly the right place at the right time. If you're 10 to 15 years away from retirement, congratulations! You're in a prime position to make significant moves. This isn't about scrambling, it's about strategizing. We're going to map out a clear, actionable path to your financial freedom. It's an exciting journey, and we'll navigate it together, turning those what-if questions into concrete plans. Let's be honest, many of us feel a bit behind when it comes to retirement savings. It's a common challenge, but it's crucial to understand that it's absolutely not too late to get on track. We're here to bridge that gap and show you how to confidently build the retirement you envision. First things first, we need to talk about your retirement number. This isn't just some abstract figure. It's the personalized goal that will guide all your planning. Without knowing what you're aiming for, it's tough to hit the target. Think of it as defining your ultimate financial finish line. Now let's introduce a sneaky thief that often goes unnoticed until it's too late. Inflation. This silent force constantly erodes the purchasing power of your money over time. What a dollar buys today will buy less tomorrow, which means your retirement savings need to grow not just to maintain their value, but to increase it significantly. Ignoring inflation is like planning a trip without accounting for gas prices. To truly prepare, you need to calculate a personalized retirement number that factors in your desired lifestyle, anticipated expenses, and the relentless march of inflation. This number will give you a clear target, transforming vague hopes into a tangible objective. It's the foundation upon which all your other decisions will rest, giving you a powerful sense of direction and control. Once you have your retirement number, it's time to unleash your secret weapon, compound interest. This incredible force allows your money to earn money on itself, generating exponential growth over time. The earlier you start, the more time compounding has to work its magic, turning small contributions into substantial wealth. Let's dive into some of the most effective investment options available, designed to supercharge your retirement savings. These vehicles offer tax advantages and growth potential that are absolutely essential for a comfortable retirement. Understanding how they work can make a dramatic difference. First up is the 401k, often offered through your employer. This is a powerful tool because contributions are made with pre-tax dollars, lowering your taxable income today. Many employers also offer a matching contribution, which is essentially free money. Not taking advantage of a 401k match is like turning down a pay raise. Next, consider the Roth IRA. While contributions are made with after-tax dollars, qualified withdrawals in retirement are completely tax-free. This offers incredible flexibility and tax predictability in your golden years. It's a fantastic option for those who expect to be in a higher tax bracket during retirement. Then there are traditional IRAs, which offer tax-deductible contributions, similar to a 401k, and allow your investments to grow tax-deferred. You pay taxes when you withdraw in retirement. The choice between a traditional and Roth IRA often depends on your current and projected future tax situation. Don't overlook taxable brokerage accounts. While they don't offer the same tax advantages as 401k IRAs, they provide tremendous flexibility and liquidity. These accounts can be a great place to invest additional savings once you've maximized your tax-advantaged options. They allow you to invest in a wide range of assets without specific contribution limits. Understanding and utilizing these accounts strategically is vital. Each has its own benefits and rules, and combining them effectively can create a robust and diversified retirement portfolio. Think of them as different engines, each contributing to the overall speed of your financial journey. Now let's confront a significant obstacle that can derail even the best retirement plans: high-interest debt. Things like credit card balances, personal loans, or even some auto loans can act as a major roadblock, siphoning away money that could otherwise be growing in your investments. The interest rates on these debts are often higher than what you can reliably earn in the market. Paying down high-interest debt is like earning a guaranteed risk-free return on your money. If you're paying 18% on a credit card, paying that off is equivalent to an 18% return on investment. It's often the most financially sound move you can make. This isn't just about reducing what you owe. It's about redirecting your cash flow toward your future. There are several effective strategies for tackling debt. The debt snowball method focuses on paying off your smallest debts first to build momentum, providing psychological wins along the way. The debt avalanche method, on the other hand, prioritizes paying off debts with the highest interest rates first, which saves you the most money in the long run. Whichever method you choose, consistency is key. Make a plan, stick to it, and celebrate each debt milestone you achieve. Freeing yourself from the burden of high-interest payments will liberate a significant portion of your income, allowing you to accelerate your retirement savings dramatically. It's an essential step toward financial freedom. You've learned about your retirement number, investment vehicles, and debt elimination. Now it's time to put it all into action with a clear step-by-step plan. This isn't about overwhelming you. It's about providing a roadmap you can follow with confidence. First, assess your current situation. Where do you stand right now? This means a thorough review of your assets, debts, income, and expenses. Understanding your starting point is crucial for determining where you need to go. Don't shy away from this honest evaluation. Second, set specific, measurable, achievable, relevant, and time-bound goals. Don't just say, "I want to save more." Instead, aim for, "I will contribute an additional $200 per month to my Roth IRA by the end of this quarter." Clear goals create clear objectives. Third, develop a realistic budget and stick to it. A budget isn't about restricting your life. It's about allocating your money intentionally. Identify areas where you can trim expenses and free up more cash for savings and debt repayment. Every dollar has a job. Fourth, automate your savings and investments. Make it effortless. Set up automatic transfers from your checking account to your retirement accounts each payday. This ensures you pay yourself first, consistently building your wealth without having to think about it. Automation removes willpower from the equation. Finally, review and adjust your plan annually. Life changes, and so should your financial strategy. Market conditions shift, your income might increase, or your family situation could evolve. Regularly checking in ensures your plan remains aligned with your goals and keeps you on the optimal path. This isn't a one-and-done process. These actionable steps, when followed diligently, will transform your financial outlook. Each one builds on the last, creating a powerful system for growth and security. This is your personal blueprint for success. Even with the best plans, the financial markets can feel unpredictable. Concerns about market crashes or economic downturns are natural, but there's a powerful strategy to mitigate these fears: diversification. Think of diversification as your ultimate safety net against volatility. Diversification means spreading your investments across various asset classes, industries, and geographies. Instead of putting all your eggs in one basket, you're distributing your risk. If one area performs poorly, others might perform well, balancing out your overall portfolio. This doesn't eliminate risk, but it manages it effectively. A common approach is to diversify across stocks, bonds, and perhaps even real estate or other alternative investments. Within stocks, you can diversify by investing in large-cap, mid-cap, and small-cap companies, as well as domestic and international markets. Bonds offer stability and income, often performing differently than stocks. The key principle is that different asset classes respond differently to economic conditions. During a stock market downturn, bonds might hold their value or even increase. This counterbalancing act helps smooth out the ride and protects your portfolio from significant losses. It's about building resilience. As you get closer to retirement, you might gradually shift your portfolio towards more conservative investments to protect your accumulated capital. However, even in retirement, some level of growth-oriented investments is usually necessary to combat inflation. Diversification is a continuous process, adapting as your financial timeline changes. You're well on your way, but let's sprinkle in a few expert tips to refine your strategy even further. These insights can provide an extra layer of confidence and ensure you're making the most informed decisions possible. Consider working with a qualified financial advisor. They can offer personalized guidance, help you create a comprehensive plan, and navigate complex financial decisions. An advisor brings expertise and an objective perspective that can be invaluable, especially as retirement approaches. They can help you see blind spots and optimize your strategy. Make sure to conduct an annual portfolio review. This isn't just about checking balances. It's about assessing performance, rebalancing your assets if necessary, and ensuring your investments still align with your risk tolerance and goals. It's your yearly financial health checkup, keeping everything on track. Finally, stay informed about changes in tax laws, investment opportunities, and economic trends. The financial landscape is constantly evolving, and being aware of these shifts can help you adapt your strategy proactively. Knowledge truly is power when it comes to your financial future. So where are we now on this exciting journey? We've covered a lot of ground, transforming what might have felt overwhelming into a clear, actionable plan. I've talked about the importance of knowing your personalized retirement number and combating the effects of inflation. You've learned about the power of compound interest and how essential investment vehicles like 401ks, IRAs, and brokerage accounts are to your success. We tackled the major roadblock of high-interest debt, emphasizing how freeing up that cash flow can accelerate your savings. And you have a concrete action plan, from assessing your situation to automating your contributions. Remember the wisdom of diversification, your ultimate safety net against market uncertainties, and the value of expert tips, like consulting an advisor and performing annual reviews. This journey is a marathon, not a sprint. There will be good months and challenging months, but consistency and a well-thought-out plan will see you through. Now take that next step. You have the knowledge and the tools. Download our free retirement planning checklist. It's linked in the description below and will help you keep all these crucial points organized and actionable. It's a fantastic resource to guide you further. If you found this information helpful and empowering, please give this video a like, subscribe to our channel for more financial insights, and hit that notification bell so you don't miss out on our future content. Your support helps us create more resources for you. In our next video, we'll be diving deep into how to calculate your precise retirement number, giving you even more clarity and control over your financial destiny. We'll break down the formulas and considerations so you can personalize your goal even further. Thank you for joining us on this Financial Freedom Countdown. Start planning today, because your future self will thank you. Disclaimer: this content is for educational purposes only and should not be considered financial advice. Please consult with a qualified financial professional before making any investment decisions. If you feel connected to our content, we are inviting you to be a part of our loyal community in the description, where you can throw in your support and generously leave a tip.